to town, from London to Taiwan. I've been all around the globe trying to protect your soul. I'm walking alone, the streets are empty. The only thing I can see is my own silhouette. I'm getting stronger, step by step. The clock is ticking, but there's no time for regrets. I've been flying from town to town, from London to Taiwan. I've been all around the globe trying to protect your soul. We are heroes tonight. We will fly above the sky. We are heroes tonight. Yeah. We are heroes tonight. We will fly above the sky. We are heroes tonight. Yeah. Feel like a dynamite, ready to explode right up in the sky. I need you to listen, I need you to hear.
So, welcome everyone, and welcome to this session today, this live stream on creating a balanced portfolio using ETFs. So I'll spend probably the first 20 minutes or so, or 15 minutes, just discussing just the basics of why would you bother with a balanced portfolio instead of just picking individual stocks. So those of you that have seen some of my previous live streams, or actually a couple of the videos that I actually still have right now on the channel itself, this might seem a little bit familiar, but it's important to kind of review this. I'm actually going to leave this one up on the channel. Again, a lot of my live streams, I usually put them, make them unlisted afterwards. So this one will remain on the channel. So just so you know, you can check it out whenever you want later on. I have some of the links that I've included in the slides. I have already pasted them into the description, but there's probably about 5 or 6 of them that I haven't included yet. I'll do that. I'll update the description as soon as I'm done. So without further ado, let's get started in talking about creating a balanced portfolio using ETFs. And again, specifically the first 15 minutes or so, I'll be talking to you about, why ETFs to begin with, or why not just trying to guess which stock to begin with. Oh, actually, sorry, I forgot one. There's one previous thing before we talk about specifically why ETFs work a bit better than individual stocks in most cases. It's basically, is investing right for you right now? Again, a lot of people are going through a very hard time currently, and unfortunately quite a few of those individuals might be going through very hard times going forward for the next few weeks, months, or potentially even years, depending on what industry you're working in. So the key thing before you're looking at what should you invest in, or key question, the first question you really should be asking yourself is investing right for me at this point in time in my life, right? Are you ready to invest right now? So what are the key things to watch out for? So the very first thing that you want to look at is, well, first of all, do you have any high interest debt? So specifically here, when I talk about high interest debt, I really talk about, credit card debt. So any form of debt that goes beyond 10% I would say anything above 7 to 10% in the current low interest rate environment should definitely be considered high interest debt. Most credit cards, how much do they charge you? Well, in most cases, between 18 and about 22, 23% or thereabouts. So the average is around 20-ish, 19, 20-ish percent or thereabouts. So this is most certainly high interest debt. And again, what constitutes high interest debt might change over time. Our interpretation of it might change over time depending on what happens in the economy. If you have very high inflation, but even 7-10% might seem very, very low. But right now, currently at least, I don't know about the near-term future, currently we have quite low inflation. If anything, prices seem to be falling for many different assets and many different items in the economy, although some will probably start growing in price. So long story short, if you have any high interest debt, so anything above 7 to 10%, and especially if you're dealing with credit card debt in the 20-ish% range, pay off that debt first. There's literally no investments, no safe investments out there, no reasonably reasonably low risk investments out there that can consistently drive that sort of return. Sure, there are some investments which are honestly more akin to gambling because they're very speculative, such as certain cryptocurrencies, such as penny stocks, etc., etc. Options trading, foreign exchange trading, and all that. I'm not saying there's no way to make money on those. There are many ways of making money on those, and many people have made money using any one or maybe a combination of those approaches. Just for the average person, if you're not doing this for as a hobby, or you're not doing this for a living, the average person is already stressed out and busy enough with their regular life as it is. So what you want to do with all the money that you might have, whether it's a tiny amount or a gigantic amount, is to invest it on the side without having to worry about trying to time the market, which is, again, it's incredibly difficult to do consistently for professionals that do this for a living to begin with. So what chance do you have? So take home here is, if you have any high interest debt, pay off the debt first. No reason wasting any sort of time trying to find some ridiculously high risk investments. It's just not going to pan out for you. Okay. Now, do you also have at least 6 months worth of emergency savings? The reason this is important, especially in an environment like today's environment, is because, again, the future is uncertain, from its, from the sheer definition of the future, right? If we knew what the future held specifically, precisely, we would be able to do so many other things. But because there's this relatively high level of uncertainty when we're dealing with future events, and especially when the economy has a gigantic question mark over its head, it's really more important than ever before to have at least 6 months worth of emergency savings. Now, I want to be very clear about this, okay? I don't mean every single person should have 6 months worth of emergency savings sitting in a high interest savings account. High interest savings account, around 1 to 2%, which is, by no means high interest in by historical norms, relatively high interest compared to many other options available today. So I'm not saying that that's the right thing for everyone. But you should have at least one way or another to access about 6 months worth of living expenses. Whether if you already have a portfolio, you already have investments, whether it's through a professional advisor, whether it's through your work and whatnot. If you're continuously getting options, or you're getting shares paid out to you one way or another, whether you're working or not, that would be a different story, right? So in certain cases, instead of having a 6 month emergency savings account or emergency fund, a lot of advisors, licensed advisor, again, keep in mind, I'm not a licensed advisor, this is for educational and information purposes only. A lot of advisors will typically recommend having some form or another of, a line of credit, so you can tap into it instead of just keeping 6 months of expenses on just in a savings account, earning you very little, in relative terms, very little. Now, so this rule is a bit more flexible depending on the situation. This is always true. Doesn't matter who you are. I don't care who you are. I can guarantee you that time and time again, right? There's no point in borrowing money from a credit card to invest. Your likelihood of success is ridiculously low. There's very few investments out there that can give you a 20% rate of return per year or higher, and there are even significantly fewer that can do that consistently. Keyword being consistent. And again, if you're just starting out with your investments, if you're in a position where you don't have any additional source of income, if you don't have any other sources of kind of cash flow that again is generated from dividend payments or anything like that, if it's literally this is the first time you're investing, this is the only money that you have, do have at least those 6 months worth of emergency savings. If you're at a different stage in your life where you have a few additional investments, you might have some rental property income. Again, rental property income, again, big question mark. A lot of people have not been paying their rents, and in many cases, all throughout Canada and many other countries as well right now, landlords are being, I don't want to say discriminated against, but basically tenants are overly protected by legislations and regulations right now, where in many cases, at least in Canada, and again, this applies to also other countries, but for sure in Canada, pretty much in no legislation in Canada, if you were to be a landlord and you don't get paid by your tenant currently for the next, well, at least until September, you're not allowed to, kick them out basically. So you're stuck with them whether they're making their payments or not, and then it's going to be all the difficult legal battles or agreements to try to get those people that, if they're still living at your in your apartment, in your house, to get them to pay rent going forward, and also all the back rent due. Obviously, they're not going to be able to make all those back rent payments in one lump sum payment. It's going to have to be stretched out over a certain number of time. So many questions. There are many questions in terms of how this is going to impact the housing market in Canada, how this is going to impact that rental income market and investment property market in Canada come fall, when a lot of these mortgage deferrals and rent payment deferrals will come to an end. Will some of them be extended? Who knows? So it's key, again, even if you had some of those, relatively consistent other sources of income, such as rental income, whether it's long-term rentals or from Airbnb, in this case, at this point, it's a much bigger question mark whether that's going to be a thing coming back in the fall or whenever that's going to be. Let me just close this. There we go. There's a few trucks passing on the street. So ideally, as I said, don't have any high interest debt. Make sure you have at least 6 months worth of emergency savings, just to be on the safe side. How secure is your job? How secure is your current source of income? Are you working for a government and you're very unlikely to get fired anytime soon? Are you working for a large corporation and you're one of those few handful of key individuals that no matter what happens to the economy, you're still going to be around? Are you one of those essential workers, and depending on which field, whether it's healthcare, whether it's shipping, whether it's grocery, supply chain management sort of stuff? So how secure is your job? Again, and these two sort of are interrelated, right? Because if you have a secure job, then maybe you can get away with just 3 months worth of emergency savings, although right now it's advised to have at least 6 months instead of 3. So how secure is your job? And then finally, can you afford to stay invested for at least 5 years or longer? Again, when you're dealing with investments, and I've discussed this in my sessions. If you're one of my students from the various, from McGill, Concordia, INRS, Carleton, etc., I've discussed this in previous sessions. So you've heard this before, and I've also discussed this in some of my previous or prior YouTube live streams. It's that it really, when there's a big difference between saving, investing, and gambling. And there's, in your life, at different stages of your life, all three are perfectly fine if you're understanding what it is that you're doing and which is right for you. So saving is anything below 1 to 2 years. If your time span is 1 to 2 years or less, obviously, right? If your time span is this happens sometimes. Like I'm gonna have to reload this because I clicked on the shortcut there. There we go. All right. So if your time span, your time frame, right, is okay. Come on. My tablet is not cooperating. Okay, here we go. Hopefully this works now. So if your time frame is 1 to 2 years or less, right? So this should be considered savings. Okay, so this is savings. If you need that money for again, to pay rent, to buy groceries, etc., 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 or if you have a large sum of money that if you want to buy a condo or a house. Again, condos maybe stick around and watch some of my upcoming live streams. Again, no one knows the future, but unfortunately there's a lot of data that is coming in, just looking at employment rates and looking at occupancy rates and so on and so forth, that in many Canadian cities, especially Vancouver and Toronto, downtown condos might be hit hardest, depending on how quickly this mess fixes itself. So if you're about to buy a condo because you can afford it and you want to live there and you're fine with it, then go ahead. if you were buying a condo as an investment property, you might want to rethink that. And again, we'll address this. Again, I cannot guarantee you that what I will be telling you in that future webinar or live stream in a few weeks when I'll talk about that, if that will come to pass. But again, we'll address that. So, but yeah, if you were to have a large down payment for a house, a car, whatever, then and you want to buy something within the next X number of a few weeks, months. So within a year to 2 years, that's savings. It's perfectly fine to have savings there, and this is also what your emergency savings is for. It's for this part here. Then investing is basically 5 years plus. 5 years plus is the ideal sort of time horizon, right? You really want to go into investing for at least 5 years or longer. The longer, the better. The statistically less likely you are to lose money. So that's investing for you, okay? And then all the sort of sexy, trendy, perhaps sometimes slightly controversial investments out there, those are typically more akin to gambling. So if anyone has been investing in cryptocurrencies, I'll put here crypto. If you bought any pot stocks, right? Marijuana is legal in Canada, has been legal in Canada for almost a year and a half at this point, almost 2 years coming up soon. If you've bought penny stocks, so these are stocks of very small, come on, penny, why is it penny? There we go, stocks. So these are stocks that trade for less than $1 a share, okay? So if you bought any of these, they're very high risk. If you've made any, options trading, any form of derivatives, any foreign exchange, so foreign exchange trading, FX changing, or forex trading, so forex, FX or forex. All these things. Yes, there are a ton of people that make money in them, but there are even more people that lose money in them. So I'm not saying never ever invest in these things. It's just because of the higher risk, technically speaking, by my definition, by the definition of many advisors out there, you cannot really call this investing. There's a high probability. The probability of losing money is quite high. Yes, there's also a higher probability of making a bit more than your market average. But because of the high risk, if you're an average investor that doesn't have the time or resources to spend a lot of time to learn about this, timing the market and all that stuff, this is more akin to gambling for most people. Okay? So because of that, you should do this in very, very small chunks, and basically do it in moderation, right? As with all things in life, if you want to do more extreme sports activities, what have you, do it in moderation, and chances are you can still have fun, but you're not risking your life, for example. So I wouldn't recommend necessarily going squirrel suit diving or skydiving every other day, unless you're a professional, right? You're increasing your chances of injury, etc., etc., etc. And then obviously the key question then is, what about the 2 to 5 years, Alex? Because now you're telling me, okay, 1 to 2 years or less is savings, 5 years plus is investing. And ideally, if you want to gamble, it's fine. Just use this, again, do it in moderation. So most advisors suggest not more than 5 to 10% of your portfolio. So if you want to buy, let's say, gold and things like that, so higher risk endeavors, do that with a relatively small percentage of your portfolio. Okay, just because again you don't really know. And again, I know a lot of people that are love buying gold and silver. They'll say no, that's not. It's nonsense. It's an investment. Again, it's probably less. It's probably less risky than some of the other things listed here. But it really depends over the time horizon that you're looking at. Anyway, so can you afford to stay invested for at least 5 years? If the answer to that is yes, then you're probably, and then your answer to these other three are also yes, you're probably it's the right time for you to invest. So now that we figured out that it may be the right time for you to invest, why ETFs? Well, ETFs, they charge you a significantly lower fee than mutual funds, and I'll show you specific examples in probably about 20 minutes from now. So they charge you significantly fewer fees for the same relative risk because you're investing more or less in the exact same thing. So obviously what you want to do is you want to minimize risk as much as possible, minimize the amount of taxes that you would pay, and minimize the fees that you pay as much as possible for the same product. So find the tax that you can hold find the product that you can hold in a specific type of account, which either eliminates or reduces taxes paid or defers taxes paid legally or taxes owed legally. So if you're in Canada, what you want to do is obviously max out your TFSA first. So TFSA is your best friend when you're lower income or just starting out. So max out your TFSA first, then start looking at your RRSPs, and consider contributing to one, especially if your employer matches a certain percentage, and especially if you're in the higher income bracket. So once you start making between about $70,000 and $90,000 in Canada, you should definitely consider contributing to your RSP. If you're making significantly less than that, it might still be the right thing to contribute to your RSP once you max out your TFSA and or your employer matches a significant portion of your contribution. Why? Well, very simple. If you're making less than that, but you're in a field where you're very unlikely to get a massive raise anytime soon, then or ever really, then you might as well just start contributing to RSP. The average salary in Canada is around $46,000. Again, this number can fluctuate significantly from coast to coast, from one city to the next. But this is basically the nationwide individual average salary is around $46,000 in Canada. So if you're making roughly the average salary and you're the most you can hope for is maybe a $2,000 raise every other year or something like that, and you've maxed out your TFSA already, and especially if your employer matches you dollar for dollar for your RSP contributions, you definitely should be considering and looking at what RSPs does the employer offer, what are the fees involved, and then run the numbers and see if that's worthwhile. And again, if this sounds too complicated, stick around. I will be having additional live streams about this, and again in late July, early August, I'll finally start uploading those videos that I've been trying to start upload and for the last 3 months. It's just been very, very, very busy winter and summer semester so far anyway. All right, so why not individual stocks, right? Well, again, this is a study that came out in 2014 done by JP Morgan. They basically looked at the Russell 3000 index. So the Russell 3000 is an index that contains roughly 98% of all publicly traded, publicly listed US stocks. So whenever you have 98% of something, you pretty much have the entire thing. Like, it's a very good representation of the entire US market. And they've considered it. They basically looked at the pretty much the entire U.S. stock market from 1980 to 2014, so over a 35-year period, which again, the average person tends to spend about 35 to about 40-ish years working. So that's pretty much an entire work lifetime, if you want to think of it that way, right? So they looked at them, and the way to interpret this graph is the black line here. This is the average stock performance, okay? And then the red one, that's the median stock performance. Now the average, it's literally you're just averaging out how much each one of these companies has, how well each one of these stocks representing these companies has done over the years, or how poorly it's done. And then you're literally just averaging it out. So you're adding stock 1 plus stock 2 plus stock 3 divided by the entire number of stocks that you have during that entire period. So that's your average in black here. The red, that's the median, and the median is basically 50% of companies, of stocks have done worse than the median. 50% have done better than the median, okay? So that's the difference. So it's really interesting to note that half of companies have underperformed the market average, the Russell 3000 average, by about 56% over this time period, okay? And about 60% of all companies had a negative return relative to, or had a lower return relative to the stock market average, right? So the really interesting thing is they also looked at they looked at all of these companies and segregated or separated them by sector. In each one of these sectors, they looked at how likely was a company to suffer something called a catastrophic loss. They defined a catastrophic loss as a decline in stock price of 70% or more from the peak with minimal recovery, meaning some of those companies dropped by 70%, then eventually went bankrupt. Others have recovered, but maybe they're only 10% up from that 70% drop. And again, the number of companies that over these 35 years that have dropped by at least 70% with minimal recovery. So again, some went bankrupt, some recovered, but minor in a minor form. Fluctuated quite a bit. There was quite a bit of variability throughout the different industries and different sectors. However, overall, if you were to average all those sectors out, it's about 40% of companies. So 4 out of 10 companies over the long term suffer a 70% decline in their stock price and never recover or barely recover anything from that. Okay, so just to make you understand that's incredibly important, because statistically speaking, it means that in any one day, and if you were to pick individual stocks, you have a 40% chance of picking a stock that over the next 35 years or thereabouts will drop by 70% or more and not recover. So those are not very good odds, right? If you had a 40% chance of getting hit by a car or a bus going from your home to your work, I guarantee you most people would not step foot outside ever, right? So that's a very, very high rate of potential losses. And this is why picking individual stocks for the vast majority of people, and even for a good number of professionals, is a losing proposition typically. Furthermore, in this study and many studies like it, have found since then that basically a very large percentage of the stock market returns of determining how well the stock market does, a very large percentage of those good returns, because again, keep in mind, a balanced diversified portfolio over the long term averages out to about 7% rate of return per year annualized, right? So it's a 7% compound rate of return. Now, a lot of that 7% compound rate of return typically is only realized in the best 10 days or so of the year. Remove the best 10 days of the market in any given year, and you'll typically have a negative rate of return for the year. Okay? Also, 73% of the time, markets typically end the year higher than they start them. But individual companies are all over the place, right? And furthermore, what contributes excessively to this return are not only the top 10 best performing days of the year, but also the top between 5 and 15 companies of that exchange. So the top 5 to 15 companies, if you're looking at, let's say, the S&P 500, the 5 largest or 5 or 6 largest companies that make up the S&P 500, which include basically Facebook, Apple, Google, Netflix. Who else is there? I think that I'm kind of covering most of them. There might be one more that I'm Microsoft. So those 5-6 companies make up between 20 and 25% of the stock market rally that you're currently experiencing. So remove those companies, and you would get make up most of the stock market rally, and they make up about 20 to 25% of the S&P 500. So if you were to remove them, the S&P 500 would have that much less value. So that's the amount of relative dollars that are invested in those 5 to 6 companies relative to all other companies in the S&P 500, for instance. So those are also known as extreme winners. They're doing particularly well because, again, when you're stuck at home or have to work remotely, you're using more and more of these online services, and you're using Microsoft for most of your word editing and spreadsheets and database management software, and maybe Teams. You're using Google for their Teams or YouTube for planning and your Gmail and planning your calendar, etc., etc., etc. Netflix to entertain yourself. Same thing with YouTube. So turns out that over these long periods of time, about 7% of companies, 7%. So this is a coincidence, by the way, that the 7% rate of return and the fact that it's 7% of companies, that's a coincidence. That has nothing to do with one with the other. Basically, there's only these extreme winners, which is in this particular study they define as 2 standard deviations above the mean. So this is 2 standard deviations. So basically within 2 standard deviations from the mean, it means you have basically about 68% of all results that are within the first standard deviation, and then about 98 or thereabouts within those 2 standard deviations. So within those two standard deviations from the mean, you have only 7% of these companies that are these extreme winners. So your chances of guessing or picking one of those few winning stocks is 7%. You only have 7% chance of picking an extreme winner. Okay. In other words, you're about 5 times more likely to pick an extreme loser than you are to pick an extreme winner. And then if you're simply going with just the market average, minimize or eliminate your taxes legally that you have to pay on it by using the proper tools and proper accounts. And then minimize your fees as much as possible by using low-cost ETFs or maybe a robo-advisor or something like that. You will literally outperform between 80 and 95% of investors depending on which data set you're looking at. That's basically the secret to investing. That's all it is. Now, if you do this professionally, if you have time to try to attempt to time the markets, which again most professionals have a hard time doing that, but you at least somewhat increase your chances of doing it if you set all those other things right, or adjust them, right? And here's this I've mentioned this reference before, and I think at least 2 of my live streams beforehand. Where does that 7% rate of return come from? So multiple studies have looked over time in terms of how what was the best and worst 5-year performance over X number of years. So this particular study looked at 54 years, and they looked at literally the best 1-year rate of return from every single month, best 1-year rate, 5-year rate of return from every single month. So from January 1st, 1960 to January 1st, 1961, what was the return? Oh, it was 86 or whatever it was within this range. And same thing, also worst return and best return for that 1 year. And then they'll look at January 1st, 1961 to January 1st, 1962. Same thing, January 1st, 1960 to January 1st, 1964 for the 5-year, etc., 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 etc. So they've done that for all of these, and these are the ranges. Worst case scenario, you lose 39.16% within the 1 year's time span. Best case scenario, you're making 86.93. I mean, that's what history has shown us. It's not a guarantee that past performance does not guarantee future results, as advisors like to say and repeat continuously. So because of that, if you have this 1 to 2 year time horizon, you're gambling. This is why I'm saying it's gambling. I'm not saying you cannot make money. It's just you have no clue what's going to happen. And same thing applies to these more novel way of investing or having your money grow by going with things like Bitcoin or some other cryptocurrency, or going with foreign exchange, etc. So it's very, very high risk. And the things that I just mentioned, those are even more high risk. But this is what would happen to basically a balanced and diversified stock portfolio. You see diversified stock portfolio here. So short term, it's a gamble. Don't invest money if your time horizon is 1 year or something along those lines. 5 years plus, best case scenario, you would have made 27.76%. Worst case scenario, you would have lost almost 2%, 1.91. So you can see that at the 5 years plus, you're pretty much if history repeats, or at least rhymes, as Mark Twain used to say. I don't want to say you're guaranteed of making money, but you have statistically speaking, a very good chance of ending up with more money rather than less. And sure enough, if you expand your time horizon to 20 or 25 years, worst case scenario, again, historically speaking, you would make 6.95%, which is very close to that 7%, or 13.76. So there's a good chance that your 7% would be a bit more than that, but mathematically, statistically speaking, there's no way to back that up. So as a result, it makes more sense to just keep the relatively conservative 7%, let's say, rate of return at that point in time. Okay. Sorry, let me just adjust this for a sec. There you go. That's a bit better. Okay. All right. So that covers that. And then finally, so now I've convinced you that now you know if you're ready to invest. You've also seen that it makes sense to invest in ETFs instead of individual companies. You've seen that 7% is not just some made-up number, and this is another reminder that you have to realize that even with more and more protectionist policy put in place with COVID-19 being a thing, there's still quite a lot of international trade. The world economy still matters to other countries. So what happens in Japan still matters to the Canadian economy and vice versa. So because of that, it makes very little sense to only invest in your own home country. You should be invested, and diversified globally. Okay, so that's where basically that whole basic standard balanced diversified portfolio of the standard 60-40 comes in, where basically if you live in Canada, you would have, so basically it's 20, 20, and 20%. Again, I'm not the one that made these numbers up. I'm simply reporting them to you. A lot of professionals have discussed and deliberated this for many, many years, and these are roughly some of the numbers that are kind of relevant to or apply in most newer cases. So this 20%, 20%, 20%, the way this basically breaks down is as follows. So you would have 20% in your home country, whatever is your home country. If your home country is Canada, that would be 20% Canadian stocks. So this is 20%, this is growth, and this is income, okay? So 40% should be in income, safe assets. These should be, and 60% in growth assets. So this works for a vast majority of people. There are other ways to adjust this. I've spoken about this in various previous sessions. I'll talk about this in future videos as well. So if you want to learn more about the breakdown, stay tuned basically. Then 20% you would go with US, and then lastly 20% international stocks. That's it. Okay. And then here 20-25% in bonds. So this can be a combination of government and corporate bonds, high yield bonds, inflation adjusted bonds, all bonds. Okay. And then 15 to 20% of preferred shares. All right. And there you go. So here you can see that the Canadian economy makes up roughly 2.4% of the world economy. Our stock market makes up roughly 3% of the world stock market. It's fine to be a bit overexposed in your home country. Why? Well, because that's typically the money that you're working in, the money that you're buying stuff in, the money that you're getting paid in. So it's okay to have this sort of disproportionate home country bias, just because that's the currency you're dealing in on a regular daily basis. All right. So one final recap. We've seen so far, when is it time for you? Is it time right now for you to figure out whether it's right for you to invest right now, right? We figured out that basically mutual funds or ETFs are better than just picking individual stocks. ETFs are typically better than mutual funds in general, just because the fees are lower for pretty much the same product. The 7%, that's again, study after study has demonstrated, this is not just the one that I listed, but just so you see that 7% is not some mythical number I'm just throwing around for no reason. And then finally, it makes sense to be properly globally diversified, whether it's 60-40 or other percentages, whatever your percentage up here is. So let's say you're going with a more aggressive 80-20. Well, at that point, just divide the 80 into 3 and the 20 into 2, and there you go. What to do if you're a U.S. citizen, and then obviously your home country would be the U.S. Well, and then at that point you're just eliminating Canada as a separate entity, and just doing the 60% divided by 2. So you would have 30 U.S., 30 international, and Canada would be part of that international holding at that point in time. All right. Okay. So that pretty much covers that. So then you also see that you need this breakdown. So now let's look at some of the tools you can use to actually create this. Well, first of all, is this percentage that I'm just showing you, which is kind of the standard balanced diversified portfolio, is that right for you, or is it a bit too risky or not risky enough? Well, let's figure it out, right? So how to get started? First of all, what you want to do is find the balance that is right for you. So, and specifically here, and again, you don't have this link in the description yet, but I will post it, okay? So this is an 11 multiple choice questionnaire by Vanguard that literally tries to figure out when you will need that money by. I'm just gonna randomly just click random things here, all right? And just see what will get what will be recommended to us, okay? All right. Again, keep in mind, I just randomly click things. So in this case, because I randomly clicked, a lot of my answers were more conservative than average. So as a result, here it recommends a 50-50 split instead of a 60-40. So you can use this questionnaire or many other ones like it online. You can just Google for more of them if you want to see more of them. And then just use that, you could just use that percentage. Or stick simply, so you have three choices. Choice number one is simply stick with the 60-40. It works for most people, and there you go. Choice number two, try to answer that questionnaire when you're again in your neutral state. That way you have an unbiased neutral opinion, and then basically by filling that out, you can figure out exactly how much you can actually afford to set aside, and how much risk can you tolerate, right? And in this case could be 50-50, or it could be that, right? So do that bit. So that's your option number two. And then option number three is to use your age as the percentage that is allocated to bonds, the safer stuff. The theory there being, as the earlier on you start investing, the younger you are, the more years you have for your investments to recover should they tank because of X, Y, or Z reason. Okay? So figure out the balance, and you know what portfolios to look at. And then what I would recommend is just to read this page from and the associated links from the Canadian Couch Potato. So the Canadian Couch Potato is a blog/website that is run by a couple of licensed financial advisors / brokers. I think it's actually not right. I think they're advisors. So you can click here and basically find out what some of your options are. So if you want to go with ETFs, these are perfectly fine ETFs. Again, the reason I'm pointing to their ETFs out instead of me just giving you a random list, keep in mind, I am not a licensed advisor. I'm not a licensed broker. I'm not allowed to give you financial advice. So I don't want you to say, well, Alex said that this ETF would be a good one. So, I did that and now I lost all my money or whatever. So I'm just pointing out that these individuals are licensed to give advice in Canada. And these are some ETFs that they're pointing out one could use to create a balanced portfolio with relatively few fees and in a relatively easy, simple, straightforward manner, right? So model portfolio one, they're using just Vanguard ETFs. So these are the different portfolios that they suggest. So you can use the previous the Vanguard questionnaire that I just showed you to figure out what your ideal percentage would be if you want to go with that approach. And then once you know your percentage, you can literally just follow that, right? And then you're done. Okay. So in this case, literally, it's the two stock or two ETF portfolio. All right. So portfolio number one, it just literally holds 35% of VAB. And that ETF basically is, it's just a bond ETF. And then option number two is to get this one, VEQT, that is invested in global markets, emerging markets, and so on and so forth. So you can use those two in the percentages listed here, or you can tinker with them even further by picking, instead of just going with the big ETFs that kind of contain other ones of these ETFs within them, you can literally just buy the individual ETFs if you have a slightly larger sum of money to invest. So again, read the fine print, understand what they're talking about, And there you have it. A secondary option is to go with this type of model portfolio using iShare products instead of Vanguard products. So that's just another option for you, basically. I'm not saying one is better than the other. All right. And here they're showing you the total fees. So basically, if you're going with a 60% bond, 60% equity, you would have a 0.2% fee, and on and on and on it goes. Same thing with this thing. That would be a 0.25% fee. So you see the fees are a bit different depending on which option you go with, but you know, they're still within that general ballpark figure. Okay. All right. So if you don't want to simply blindly follow their investment advice or those specific ETFs that are listed there, what are some of your options? Well, you can use the Morningstar Canada ETF screener tool, which is a free tool to use. You don't have to sign up, you don't have to create an account or anything. Again, I'll include the link to this. Apologies, last night I've been answering emails until basically 4 a.m. So I've had a bit of a long couple of nights here, just, you know, being busy. Never a dull moment, shall we say. All right, so you can basically select your provider. So let's say you want to look at those iShares. Now, iShares is owned by BlackRock. So let me just see, because I saw BlackRock over there. I'm just curious to see if they have iShares also listed, or they're all under BlackRock. They might be all under BlackRock, I think. No. There. iShares. And yeah, so you can select this by Morningstar rating. You can select this by risk level, management style, yield, etc., etc., etc. So now, obviously, if I'm pressing show more, it'll show me a good number of ETFs here. So 515 ETFs specifically. Okay. So you can use this to determine which ETFs to go with if you don't want to use the standard ones that are listed on the Canadian couch potato that are talked about there. Make sure that whenever you're opening your investment account, you're opening an account with a broker or financial institution that is CIPF listed. So the CIPF stands for the Canadian Investor Protection Fund, and what they do is they guarantee each type of account per financial institution up to $1 million. So on the off chance that your broker goes bankrupt, up to $1 million will be refunded to you based on whatever the price or the value of those individual stocks or ETFs or mortgage backed whatever it is, securities, or whatever other things that you've invested in, based on whatever that value is. All right. And then obviously going forward, just use dollar cost averaging whenever you have money. In other words, just keep on buying the same stuff in the same proportions, and eventually the prices will stabilize and increase. Okay. And what you want to also do is you want to maintain your portfolio balance. It's not unlikely that sometimes certain industries move a lot faster than others. You might have had, various sporting events canceled, and they'll take a while to recover. So if there were any sort of investments in sporting arenas or things like that to be made, that's probably going to be a very slow one. Whereas if you were to look at things like bonds, for example, they dropped as well as stocks, but they recovered a lot faster. And some bonds actually started going up as stocks were dropping. And again, if for whatever reason you want to invest in sporting equipment and you want to keep that at 1%, let's say, of all your investments, or sporting arenas, then make sure you adjust that over time, because if their value drops further or increases, and the relative value that you have access to, you might be on the hook for the difference in the cases where basically it's you have these discrepancies, as it were. So basically, if you would be on the hook for trying to rebalance it yourself, because otherwise, let's say you want a 5% exposure, but all of a sudden that particular part of the economy does very poorly, and now you only have 2% exposure. Or what if that part of the economy does really, really, really well? Does that mean you should be keeping just those? So it's quite frequent that people want to keep the winners and sell the losers. You should do the reverse. Buy things that have dropped in price and sell things that have gone up in price. That's typically a better way of looking at things, all right? And that's just the basic definition of dollar cost average, and I'm going to include a link to that. So very quick wrap up here, all right? So drops of 10% or more in the stock market are normal to occur at least once a year, okay? 5% or more, the stock market typically has an average of 5% or more drops per year. So the market drops by at least 5% or more at least 3 times per year on average, and drops by at least 10% or more once per year on average. Drops in the stock market value of 20% or higher occur at least once every 5 to 7 years. So this is why it's incredibly crucial, incredibly important not to pay too much attention to the naysayers, to people that say, oh my God, the economy is doomed, everything's going into, it's done with, etc., etc., etc. So really try to focus in on those things that you can control, and be aware that the markets are volatile in normal times. This is why on my very first slide I was talking about, like, how secure is your income? Do you have at least 6 months worth of emergency savings? Have you gotten rid of high interest debt such as credit card debt, etc., etc., etc.? And keep in mind, nobody can accurately and consistently, and the key word there being consistency. So consistently, can they consistently forecast the market? I've had random flukes, and I've also had very, very large losses. So random flukes in terms of gains, but also very large losses in certain cases, because the market just kind of did something completely unexpected, right? So nobody can consistently and accurately forecast the market, every single move in the market. The market will recover. That's an incredibly important thing to keep in mind, because every single time you're buying a stock, every single time you're buying an ETF, every single time you're buying a mutual fund, you're not just buying ones and zeros on your screen. You're buying a company. You're becoming part owner of a company that is made up of people, that is made up of technology, that is made up of new solutions to troubles that we're having in the modern day and era. So this is why it's incredibly important to understand how these things work and function. Okay, and yes, it might take a while for the economy to recover. Hence the 5 years plus time horizon, which is kind of a necessity at this point in time. But things will eventually recover. To what extent, exactly, what will it look like? That I don't know yet. But things always do eventually recover, I should say. Only invest if you can ride out the ups and downs to come over the next, again, roughly 5 years, I would say. Okay? If not, it might not be the right time to invest. And the worst thing you can do about investing is not to just lose money randomly, right? It's the worst thing, it's what's even worse than that, is to lose money on the right stock. Because it's one thing when you're just picking a random stock and you didn't do your research, and then they crash, they go bankrupt, or they lose a significant portion of their income stream. But it's incredibly annoying, incredibly frustrating when you did your due diligence, you did your research, you buy the winning stock, you're buying the next Facebook, you're buying the next Amazon. But then something intermediately happens in the middle of all of this. So you're buying it, maybe you're making 5%, 10%, whatever. And then while you're still invested in that stock, something bad happens. The stock price drops by like 20, 30, 50%, and then you're forced to sell at a loss because you need that money for something. And then 2-3 years later, it turns out that stock is booming like crazy, right? It's at peak and beyond anyone's imagination in terms of how big it's gotten. That's even more frustrating, more infuriating to an investor than having invested in a wrong thing. When you're investing in the right thing, but just a little too early, and then or you would have stuck around with it, but something happens in your personal life. So this is why it's key to have those 5 months worth of 6 months worth of emergency savings, just to be on the safe side of things, and be able to ride out those storms. All right, so that's pretty much all I want to tell you about today. So let's just very briefly recap or revisit this Morningstar ETF selector tool, right? So actually, let's just use a couple of these. So let's use the Canadian couch potato link. All right. something wrong with my display? Hold on. There you go. So I have too many screens. So I was like, where on earth did the thing go? Okay, no, it's back here. Okay. Okay. So now we're good. Okay, so now the really fun part is this. So here, let's just very quickly, let's just pick these Vanguard ones over here, right? So let's say VEQT, or here, because you can again select those, or you can just build a portfolio with the smaller ones, like the in between ones. So let's say you go VCN, okay? VCN. So just type the ticker VCN here, right? So you already know what you're looking for. You're looking for VCN.TO taking screen because those are listed on the Toronto Stock Exchange. Okay, so yeah, never mind. You don't have to include it. I forgot because some of these websites you need to include a .to for it to find. This one doesn't. So just VCN. And basically, it'll give you some information about the fund itself, right? So it'll show you how they perform relative to other indexes, other investments, yada, yada, yada. And it'll also give you a rating, right? The Morningstar rating for a 3 or 5 year, and how it's basically pretty decent. So 4 out of 5 stars, and all of this. Okay, so this is how you can basically use the one of the links that offers you this to then do your own research and figure out whether that's the right investment for you if you're happy with that. Okay. And again, I'll go into more details about the specifics in terms of what are some of the strategies, how to actually do some trading, all of that stuff. I'll make a few short videos. As I said, recently I've been flooded with a lot of emails. I've been working on various projects. I've been working on a paper and another publication somewhere. It's been very, very crazy. And yeah, last week or so, I've probably been getting on average of like three hours a night of sleep. So that's why my energy level is quite low, and that's why I'm waiting to make those more fun, short videos, short to the point videos with a lot less rambling, when my work schedule is a bit less insane and I'm not like falling asleep talking to you because I haven't slept last night much. So anyway, so I hope this was helpful and useful. Oh, and also here, if you want to double check the CIPF, as I said, I'll include every single one of these 5 extra links that I haven't included already in the presentation. I'll include it shortly, and you can basically see the full list of all of those that are covered by CIPF. So make sure you pick one of these basically. So the big guys are there, right? So you have, let's say if you're looking at TD, for example, you see RBC Direct Investing. You'll also have TD Securities, TD Waterhouse, and so on and so forth. But you also have some of the smaller guys, like Questrade, for instance. So as long as you open an account with a member unit of this, or a company that's a member of CIPF, is covered by CIPF insurance, then your chance of losing your money in case the company goes bankrupt is pretty much eliminated, because up to $1 million is covered by the federal government, by the CIPF, because it's the Canadian Crown Corporation. All right, so that's pretty much all I wanted to tell you today. I see there's not too much chatter in the chat, so I think that's pretty much all I want to say. If you have any questions, feel free to drop a comment below, and I'll get back to you, as soon as I see the comment. And yeah, so hope this was useful to everyone in attendance, and I'm looking forward to maybe catching you